Welcome to the deep dive. Today we're tackling something really critical, especially if you're, say, in your 50s and thinking about what's next.
Yeah, we're talking about debt. And more importantly, how to get rid of it and actually secure some, financial independence.
Exactly. Because this stage of life, the clock really does start ticking towards retirement, doesn't it?
It does.
And for so many men, especially, carrying significant debt feels, well, it's stressful. You've got credit cards, personal loans, even a mortgage hanging over you.
It chips away at your confidence, too. You're supposed to be looking forward to freedom, right? Not worrying about making minimum payments.
Mm-hmm. And the numbers really back up that stress people are feeling.
Oh, absolutely. When you look at the data, households headed by someone 50 or older, they're often nowhere near debt-free.
So it's not just a feeling, it's the reality for most people.
It is. Our sources show only about, 37% of retirees are actually debt-free, a minority.
Wow. Okay, so almost two-thirds are carrying debt into retirement.
That's right. And even though men in their 50s are often at their peak earning years, they're carrying these heavy loads. Think about this. Back in 2022, the median debt for households headed by someone 55 plus, it was $61,000.
61,000, that's substantial.
It is. And that debt, especially the high interest kind, it does more than just drain your bank account. It actually fundamentally changes your retirement plans.
How so?
Well, think of retirement as this open highway you're driving towards, right? Financial independence. But that debt, it turns the highway into this never-ending series of toll booth stops you keep having to pay, and it slows you right down.
That's a powerful image, toll booths, constantly losing ground.
Exactly.
Okay, so our mission today in this deep dive is to pull together the clearest, maybe the most aggressive strategies we can find.
Right.
We've looked at financial institutions, retirement experts, consumer protection agencies,
Right.
to build a really actionable plan, something specific for tackling this midlife debt, boosting that confidence and making sure these final, really powerful working years count towards freedom.
And it's not just about cutting back on everything, is it? It is not pure austerity.
No, not at all.
It's about creating a structure, a path to get back real, tangible control over your finances, which is so important for men in this age group, maybe juggling kids' college costs or dealing with job changes or even life events like divorce or widowhood.
Getting back in the driver's seat.
That's the goal.
So let's start with the costs people don't always tally up. The emotional cost.
Yeah.
Sometimes that's what stops people even looking at the statements.
Oh, absolutely. That feeling is what we call financial distress.
Okay. What does that actually mean, financial distress?
Well, technically, it's just when your income isn't enough to consistently cover your financial obligations, your bills, basically.
But it feels like more than that.
It is more than that. For many people, it shows up as, extreme anxiety, trouble sleeping, maybe this pervasive feeling of failure. And that can be particularly tough for men who, culturally feel they should be financially stable by their 50s.
Right. The provider expectation.
Exactly. And our sources are really clear. Ignoring it, just hoping it goes away, that's the fastest route to potentially devastating outcomes, maybe even bankruptcy down the line.
So you absolutely have to face the numbers, put the fear aside for a minute.
You do. As one expert put it, the very first step, maybe the most crucial one, is just getting some peace of mind back.
And how do you get that when the numbers look scary?
The peace comes not from waving a magic wand and having zero debt, but from knowing exactly where you stand. You have to look at the total, create that clear picture, even if it's daunting. That's the start of regaining control.
Okay. So step one, face the total. Step two.
Step two is categorization. This is absolutely key. You need to separate the immediate emergency from the, let's say, long-term project. Meaning we have to distinguish between bad debt and what we might call good or maybe strategic debt.
Okay, let's unpack that because that distinction sounds like it drives the whole payoff strategy. What's the real difference, especially if you're in those peak earning years?
Right. Bad debt is, it's priority number one. For immediate elimination, this is your high-interest debt, usually stuff that isn't tax deductible that you used to buy things that, frankly, go down in value. Consumables.
The prime example being?
Credit cards, absolutely. If you're financing, say, electronics or last year's vacation or even just dining out at, 20%, 25% interest, you are essentially lighting money on fire every single month.
Wow. And you said it's common.
Very. Our data shows something like 68% of retirees who still have debt point to credit card balances as a major part of it. This debt has to go aggressively because that interest rate, it's like a guaranteed negative return on your money.
Okay, so credit cards. Enemy number one. Got it. What about the other side? Good or strategic debt?
Generally, this is lower interest debt used to finance assets that ideally appreciate over time or provide some long-term economic value.
Like a house.
A mortgage on your main home is the classic example. Or sometimes maybe a well-managed, low-interest student loan, perhaps for yourself or your kids. The key difference is that interest rate. It's usually way lower than what you might hope to earn on investments, and often the interest might even be tax deductible.
Okay, but let me push back a little there. For men in their 50s, even if a mortgage rate is low, say 4%, isn't there a really strong psychological pull to just be done with the mortgage before retiring?
That's a really important point. And yes, absolutely, psychologically, many people want that mortgage gone.
So how do you balance that feeling with the math?
Well, mathematically, yeah, holding a 4% mortgage while your investments might be making, say, 8%. You're technically ahead. You're earning on that difference. But for the purpose of this deep dive and getting control back, the absolute #1 consistent focus has to be eliminating that high-interest bad debt first.
Okay.
Once that 20% credit card is history, then we can talk about the mortgage. That becomes a question of preference, cash flow, peace of mind. It's no longer a five-alarm fire.
Don't let the good debt stop you from killing the bad debt.
Precisely. You can't let paying extra on a low-interest mortgage slow down getting rid of that crippling high-interest stuff.
Makes perfect sense. Okay, let's talk about the big picture metric here. Net worth. Debt obviously impacts this.
Fundamentally, net worth is your financial snapshot, right? Your assets, everything you own, house, investments, cash, minus your liabilities, everything you owe, all your debt,
So paying off debt.
is a guaranteed way to increase your net worth. Dollar for dollar, it's arguably the most important number to track as you get closer to retirement.
And when we look at that net worth picture for the demographic we're focused on, say ages 55 to 64, the numbers are, well, they tell a pretty stark story, don't they?
They really do. There's massive inequality, which highlights exactly why getting rid of this debt is so crucial for so many.
What do the numbers show?
Well, the Federal Reserve's data, the Survey of Consumer Finances, it shows this dramatic skew. The average net worth for that 55-64 age group looks pretty high, actually. It's about $1.57 million.
Okay, sounds good.
It does, but wait. That average is massively pulled up by a relatively small number of very wealthy households. The number that reflects the reality for more typical people is the median net worth.
And that is?
Only $364,500.
Wow. That's a huge difference, over $1 million between the average and the median.
Exactly. And that debt we talked about earlier, that $61,000 median debt load for the 55-plus group, that's precisely what keeps many men stuck firmly in that median group, or maybe even below it.
So tackling the debt is the key to moving up.
It's the immediate key. It protects and helps grow that $364,500 number. It's what lets you start leveraging those peak earning years to actually build wealth. Instead of just feeding the minimum payment monster on your credit cards, you can't get closer to that higher average cohort if debt's holding you back.
Okay, so this brings us squarely to action. We understand the stakes. The 50s peak earning years. It's a critical window, isn't it? A window that doesn't stay open forever.
It really is. Income often stabilizes or even drops as people approach or enter retirement. So this period, right now, has to be maximized.
And the strategy has two parts, you said.
Yes, it's a dual focus, and it's pretty non-negotiable if you want to make real progress. You have to, one, aggressively eliminate that high interest debt we just defined, and two, at the same time, you need to be seriously boosting your retirement savings.
Both together.
Both together. If you only do one, you're leaving future security and wealth on the table.
All right, let's start with prong one, elimination. The absolute priority is hitting that high interest debt first. Credit cards, personal loans. Why is that rule so strict? Can't you just split extra money, say 50-50, between paying down debt and saving more?
You could, but the math just doesn't work out in your favor when you've got that high interest debt. Think about it in terms of guaranteed returns.
Okay.
Our sources really hammer this home. There is virtually zero likelihood that your retirement account returns, even in a great year, are going to consistently beat the cost of a 20-25% credit card. It's just not realistic.
So paying down the debt is the return.
Exactly. If you pay off $1 of debt that's costing you 20% interest, you have just locked in a guaranteed risk-free 20% return on that dollar. Instantly.
Whereas if I invested that dollar,
maybe you get 7% on average over the long term if you're lucky and depending on the market. Maybe less. That difference, that 13% or more, that's a direct loss you're choosing by not paying the debt first.
wow. Okay, put that way, it's obvious. Directing money to that 20% debt is the single highest performing investment you can make right now.
Absolutely. Every single dollar you spend paying high interest is a dollar that could have been working for your future self. That's why elimination comes first, before you really ramp up allocations elsewhere.
All right, so high interest debt is being attacked. Maybe it's gone or well on its way. Then prong two kicks in, boosting retirement savings. And you mentioned reaching age 50 gives you a special advantage here.
Yes, a huge one. It's through something the IRS offers called catch-up contributions.
Catch-up contributions.
It's a massive tool, and frankly, it's often underutilized. It's for anyone who feels maybe they started saving a bit late or life got in the way, and they need to accelerate that savings growth fast.
How does it work?
The government basically recognizes that people nearing retirement might need or want to save more aggressively. So if you're 50 or older, they allow you to contribute more money to your tax-advantaged retirement accounts, like your 401k or IRA, than the standard limit for younger folks.
Okay, let's put some real numbers on this. How much more are we talking about? This could be significant.
It really is. Let's look at 2025 figures as an example. The standard contribution limit for a 401k is, say, a $23,500. Pretty good. But if you're 50 or older, you can add an extra $7,500 on top of that as a catch-up contribution.
7,500 more.
Yep, bringing your total potential 401k contribution up to a whopping $31,000 for the year.
Wow.
And it's not just 401ks. For IRAs, there's an extra catch-up too, usually around $1,000 above the standard IRA limit.
That extra $7,500 a year in the 401k, compounded over, say, 10 or 15 years of those peak earning years, that's got to make a massive difference.
It's absolutely a game changer. Let's run a quick hypothetical. If a man diligently saves just that extra $7,500 catch-up amount every year for 10 years, let's assume a pretty modest 6% average annual return.
Okay.
That's $75,000 in extra principal contributions.
Yeah.
But with compounding, that extra bit alone could easily grow to over $100,000 more in his retirement savings, just from using that specific tax rule designed for this age group.
Incredible. So maximizing these tax-advantaged accounts, 401k, IRA using these catch-up provisions is essential.
Essential, especially if you're trying to hit those savings benchmarks that financial experts recommend.
What are those benchmarks? What should someone be aiming for by, say, age 60?
Well, firms like Fidelity often suggest aiming for about 8 times your annual income saved by age 60, and then 10 times your income by age 67, around traditional retirement age.
8 times and 10 times.
Okay. So if you look at your current savings and realize, oh, I'm only at 5x or 6x, then this dual strategy, aggressively paying debt and maxing out those contributions, including the catch-up, that's really your only realistic path to bridge that gap before you plan to stop working.
And if you don't have an IRA already,
Open one. Fund it immediately. It gives you another avenue for tax-advantaged saving and investing, potentially helping you hit those targets faster.
Okay, so scenario. High interest debt is gone. Retirement savings are being maxed out, catch-ups included. Then we can circle back to the quote-unquote good debt, like the mortgage.
Exactly. Only then does strategic mortgage management really come onto the table.
And what are the options there?
Well, since the mortgage is likely low interest compared to what you were paying, it's now at the back of the line. But once the bad debt's cleared, sure, you can focus on it. Maybe you refinance if rates are favorable, lock in an even lower rate or shorter term. Or you could simply start making accelerated payments, maybe bi-weekly instead of monthly, or just adding extra principal each month.
But you gave a really important warning earlier about not getting too aggressive with the mortgage, even now.
Yes, and this is critical, especially for someone in their 50s who might be feeling that psychological pull to just wipe it out using all their peak income.
What's the warning?
Do not rush to pay off that low-interest mortgage if doing so compromises your financial safety net.
Meaning?
Specifically, 2 things. 1, don't drain your emergency fund, that essential 3 to 6 months of living expenses we'll talk more about. You need that buffer. 2, don't sacrifice those maximum retirement contributions we just discussed, especially the tax-advantaged ones with catch-up potential.
Why not sacrifice the retirement contributions? If the mortgage is gone, isn't that good?
It feels good, but think about the math again. If you're getting, say, a company match on your 401k plus potential growth, that's maybe a 7%, 8%, or even higher effective return. Why would you give that up just to save 4% interest on your mortgage? It's mathematically backward. You're sacrificing future wealth for comfort right now. Keep the emergency funds solid, keep maxing out retirement accounts, then attack the low-interest mortgage with whatever is left over.
Okay, executing this dual strategy, paying down debt while saving. It takes serious discipline. Let's get tactical now. What are the actual methods people use to stay motivated and focused on the debt payoff part? I know there are two main schools of thought.
That's right. The avalanche method and the snowball method. It's kind of the classic debate in personal finance. Pure math versus human psychology.
And you really need to know yourself to pick the right one, I imagine.
Absolutely. What works brilliantly for one person might cause another to give up.
Okay, let's start with the one that, on paper, saves you the most money. The avalanche method.
Right. The avalanche is all about logic and efficiency. You list all your debts, not by size, but strictly by interest rate, highest rate at the top, lowest at the bottom.
Highest interest rate first.
Exactly.
Okay.
You throw every single spare dollar you can find at that debt with the highest interest rate while just making the minimum payments on all the others. Once that top debt is gone, you take all the money you were paying on it, the minimum plus the extra, and you attack the debt with the next highest interest rate, and so on.
And why does this save the most money?
Because you're minimizing the total amount of interest paid over the life of the loans. You're tackling the most expensive debt first, so less of your money gets eaten up by interest charges overall.
Makes sense mathematically. What's the catch? Why doesn't everyone just do this?
The catch is discipline. It requires real staying power. Because what if your highest interest debt is also your biggest one? Say a $25,000 personal loan at 18%. It could take you a year, maybe longer, just to knock out that one debt. And during that whole time, you haven't had the satisfaction of actually eliminating a debt completely. That can be really demotivating, especially if you're feeling overwhelmed by the total amount you owe.
Okay, I can see that. Which leads us perfectly to the other method, the snowball. I suspect this one might resonate more with men over 50 who feel a bit defeated by their debt and really need to see some progress fast.
I think you're right. The snowball method is often recommended by financial counselors precisely because it harnesses psychology. It's all about momentum.
How does it work differently?
With the snowball, you still list all your debts, but this time you order them from the smallest balance owed to the largest balance owed, regardless of the interest rate.
Smallest debt first.
You attack that smallest debt with every spare penny while paying minimums on the rest. Because it's small, you'll likely pay it off relatively quickly, maybe in a few weeks or months.
A quick win.
Exactly. You get this huge psychological boost. You see a debt disappear. You prove to yourself you can do it. Then you take the money you were paying on that now gone smallest debt, its minimum payment plus all the extra you were throwing at it, and you snowball it onto the minimum payment of the next smallest debt.
So the payment amount grows as you knock off debts.
Right. And because you're knocking off debts faster, even if they're small ones, you feel like you're making rapid progress. You see the number of creditors you owe dropping. That momentum can be incredibly powerful to keep you going until all the debts are gone.
Can you give a quick example, just to make it concrete?
Sure. Imagine you have, say, 5 debts. Smallest is maybe a $500 store card at 15% interest. The largest is a $10,000 loan at 22%. Using the snowball, you hammer that $500 debt. Maybe it's gone in 3 weeks. Boom. Victory.
Feels good.
For someone who hasn't felt financially successful in maybe years, seeing that statement that says $0 balance, that provides the motivation, the fuel to keep going and tackle the next one and the next, even if mathematically focusing on the 22% loan first might have saved, say, an extra $50 in interest over the long run.
So the momentum itself is the return on investment here, in a way.
That's a great way to put it. For many people, that psychological win is worth far more than the small amount of extra interest paid.
Okay, so whether you choose avalanche or snowball, there's a foundational step that has to happen first, right? You called it stopping the bleeding.
Absolutely critical. You cannot start a successful debt payoff plan if you're still digging the hole deeper by adding new debt unnecessarily.
Makes sense, like trying to bail out a boat with a leak in it.
Exactly. So the very first action is to stop accumulating new non-essential debt. Put the credit cards away for discretionary spending. Commit to living within your means now.
And once the leak is plugged,
then you have to get really honest and granular with your budget to find the money to actually pay off the existing debt. We need to reclaim cash flow.
And we're not just talking about skipping a latte here, are we? For this age group, with potentially higher incomes but also higher expenses, where do you find meaningful amounts of cash?
You have to look at the bigger categories, often things relevant to this stage of life. Transportation is a big one. If you're a 2-car household, but maybe one spouse is working remotely now or semi-retired, could you realistically get by with one car?
That would save a lot. Insurance, payment, gas, maintenance.
Huge savings. Look hard at dining out and entertainment. It adds up incredibly fast. Even cutting back significantly, say. Saving $400 a month that used to go to restaurants or subscriptions you don't use, that $400 can make a massive dent in a credit card balance when applied directly to the principal.
And you need to reframe it mentally.
Yes, this isn't about deprivation, it's about gaining control. Every dollar you free up and throw at debt is a dollar you're investing in your future freedom and peace of mind. It's empowering, not punishing.
Okay, what about unexpected money? Like a bonus at work or maybe a tax refund or even an inheritance? What's the rule for that found money?
Directive is crystal clear. If you have high interest debt, especially credit card debt, that windfall goes directly to pay it down, immediately.
Why immediately? Why not invest it?
Because, again, paying off 20% debt is a guaranteed 20% return. No investment you can make right now is likely to offer that kind of guaranteed risk-free return. Using found money to kill high-interest debt is the smartest, fastest way to boost your net worth with that cash.
All right. Now, a potentially sensitive area?
Yeah.
What about using existing assets? If someone has money sitting in, say, a certificate of deposit, CD, or maybe some bonds, something relatively safe but low return, should they consider liquidating that to pay off high-interest debt?
This requires a careful comparison, but yes, it should absolutely be considered.
How do you make that decision?
You have to compare the numbers. Look at the interest rate you're paying on your debt versus the interest rate you're earning on those fixed investments.
For example,
If you're paying, say, 18% on a credit card balance, but you only have a CD that's earning you maybe 4%, well, keeping that CD while carrying the debt is actually costing you money every day. You're losing 14% on that spread.
so in that case, liquidate the CD.
Generally, yes. You should strongly consider liquidating some of those low-return fixed holdings to pay off the high-interest debt.
Okay, but wait, doesn't that deplete your savings? What about the emergency fund? That sounds kind of scary, using savings to pay debt.
That's the absolutely crucial distinction. We are not talking about touching your core emergency fund. That 3 to 6 months of essential living expenses held in cash, that stays put. That's sacrosanct.
Okay.
The fixed investments we're talking about liquidating are funds above and beyond that minimum emergency cushion. So if you have your $15,000 emergency fund secure, and you also have another $10,000 sitting in a CD earning 4%, while you owe $12,000 on a credit card costing 20%.
Use the CD money.
Yes. Use that $10,000 from the CD to kill most of that credit card debt. You just locked in an immediate, massive 16% difference in effective return on that money. As long as your primary emergency fund remains untouched, it's usually the smart move.
Okay, sometimes even with aggressive budgeting and the right payoff method, the interest rates themselves are just too high, too crushing. That's when we need to look at actually restructuring the debt, right? Let's start with debt consolidation loans. How do those work?
Debt consolidation loans can be a really powerful tool, but only if used correctly. The basic idea is you take out one new, larger loan, usually a personal installment loan from a bank or credit union, and you use the money from that loan to pay off multiple smaller, high-interest debts.
So you combine several payments into one.
Exactly. You consolidate maybe 3 or 4 credit card balances, maybe a store card, into one single loan with one single monthly payment. The big potential benefits are simplifying your finances, just one bill to track, and, crucially, getting a much lower interest rate.
Okay, but you said if used correctly. What's the catch? What's the safety condition here?
The condition is non-negotiable. The consolidation loan is only effective and safe if the interest rate on the new loan is significantly lower than the average rate you were paying on the debts you're consolidating.
So if my credit cards average 22%, I need the new loan to be.
Ideally, single digits, maybe 8%, 9%, 10%, something substantially lower. If you just move debt from a 20% credit card to a 20% personal loan, you haven't really accomplished much except maybe shuffling paper. The goal must be to reduce the overall interest burden.
And there's another safety measure needed too, isn't there? What do you do with the old credit cards?
Yes. This is vital. Once you use the consolidation loan to pay off those credit cards, you absolutely must either close those accounts or at the very least put the physical cards away and commit to not using them again. Otherwise, the temptation is huge to just run the balances right back up, and now you've got the consolidation loan plus a new credit card debt. That's a disaster.
Right, digs the hole even deeper. Okay, what about balance transfer credit cards? Those offers for 0% interest for a year or 18 months? Sounds
Yeah.
pretty tempting.
They can be tempting, yes. And they can be a useful tool, but they require even more discipline and careful planning than consolidation loans.
How do they work?
You apply for a new credit card that offers a 0% introductory annual percentage rate, APR, on balances transferred from other cards. You then move your high interest balances over to this new card. For the introductory period, typically 6 to 18 months, you pay no interest on that transferred balance.
Sounds great. What are the risks?
Two major ones. First, you almost always pay a balance transfer fee up front. It's usually a percentage of the amount you transfer, often 3% to 5%. So transferring $10,000 might cost you $300 to $500 right off the bat.
Okay, got to factor that in. What's the second risk?
This is the bigger one. You absolutely must have a solid plan and the discipline to pay off the entire transfer balance before that 0% introductory period ends.
Why? What happens if you don't?
If you still have a balance remaining when the promo rate expires, the regular interest rate kicks in, and that regular rate is often very high, sometimes 25% or more. Even worse, some cards might apply that high rate retroactively to the entire balance from day one.
Ouch. So you could end up paying even more interest than before.
Potentially, yes. So this strategy is really only safe if you have very predictable income, maybe a bonus coming that you know will cover it, and the rock-solid discipline to get that balance to zero before the deadline. And you generally need good to excellent credit to qualify for the best 0% offers in the first place.
Okay, so consolidation loans might need decent credit, balance transfers need excellent credit and discipline. What if someone's credit isn't great and they feel overwhelmed? Is there a more structured, safer option?
Yes, there is, and that's usually a debt management plan or DMP. These are typically offered by nonprofit credit counseling agencies.
Nonprofit credit counseling. Okay. How does a DMP work?
A DMP is designed for people who are struggling with unsecured debt, mostly credit cards, medical bills, maybe some personal loans, but they still have enough income to make some kind of regular payment, just maybe not the full minimums at those high interest rates.
So what does a counseling agency do?
The counselor essentially acts as your representative and negotiator with your creditors. They work out a structured plan. They contact your credit card companies, for instance, and negotiate two main things on your behalf.
Which are?
First, they aim to get your interest rates significantly lowered, often down to maybe 6%, 8%, sometimes even lower, which is a huge reduction from the typical 20% plus. Second, they often get late fees and over-limit fees waived.
That sounds like a massive help, a lifeline, really.
Yeah.
What's the client's part in this?
The client's role is simple but requires commitment. You make one single consolidated monthly payment directly to the credit counseling agency. The agency then takes that payment and distributes it proportionally to all your creditors enrolled in the plan.
So it simplifies payments again and lowers the cost.
Exactly. It provides immediate structure, makes the debt affordable again, and usually stops the harassing collection calls. It gives you a clear path out.
What's the downside or the commitment required?
The commitment is time and consistency. DMPs are not a quick fix. They typically require you to make those agreed-upon payments consistently, on time, every month for a period of maybe 48 months or even longer. Usually 3 to 5 years is typical to complete the plan and become debt-free. So you get affordability, but it requires a long-term, disciplined commitment.
Okay, that makes sense. Now, we have to talk about some higher risk options, particularly those involving home equity. Many men in their 50s have built up significant equity in their homes. What about using a home equity loan or a HEL, home equity line of credit?
This is where we need to flash some serious warning lights, big ones.
Why? The interest rates are usually much lower than credit cards.
They are, and that's the lure. You can often tap into your home equity and get cash at a much lower rate. However, the risk is catastrophic. Unlike credit cards or personal loans, home equity debt is secured debt, meaning your house is the collateral for the loan. If you take out a ALOC to pay off, say, $30,000 in credit card debt, and then life throws you a curveball, you lose your job, have a major health issue, your income drops unexpectedly.
You could lose your home.
You could face foreclosure. That risk is infinitely higher and more devastating than defaulting on a credit card. Especially for someone nearing retirement, losing your home is unthinkable.
And isn't there also risk with variable rates on ACOLOs?
Absolutely. Many ALOCs have variable interest rates tied to the prime rate. If the Federal Reserve raises interest rates significantly, your monthly ALOC payment could jump unexpectedly, creating payment shock right when you can least afford it.
So the advice is?
Be extremely cautious. ALOS might make sense for certain things, like value-adding home improvements, and only if your income stream is rock solid and predictable. But using home equity to pay off unsecured consumption debt, especially if your income is variable or you're nearing retirement, that's generally considered far too risky by most financial advisors.
Okay. What about reverse mortgages? That's specifically for older homeowners, right? Age 62 plus?
Yes, strictly 62 and older. A reverse mortgage is a very specialized, complex financial tool. It's designed to allow older homeowners who have significant equity built up, maybe their house is paid off or nearly paid off, to convert some of that illiquid equity into cash.
And how might that help with debt?
Well, the cash received from the reverse mortgage could potentially be used to pay off existing debts, like remaining mortgage balances or high-interest credit cards. The key feature is that generally, you don't have to make monthly payments back on the reverse mortgage loan as long as you live in the home. The loan becomes due when you sell a home, move out permanently, or pass away.
So it could help someone who is house rich but cash poor.
Exactly. It's potentially useful for retirees with significant home wealth, but maybe limited savings or investment income who need to eliminate debt to improve their monthly cash flow. But reverse mortgages have high upfront costs, complex rules, and potential impacts on heirs. They absolutely require careful consideration and mandatory counseling from an independent advisor who specializes in them, not a first resort by any means.
All right, let's assume the debt payoff plan is underway. Whether it's snowball or avalanche, things are moving.
Right.
What's the next critical step to make sure this progress sticks?
We need to build a defense, right? A financial shield.
Absolutely. Once you've stopped the bleeding and have momentum, you need to fortify your position. And the cornerstone of that defense is your emergency fund.
We mentioned it briefly before. Why is it so crucial beyond just having cash for emergencies? How does it protect the debt plan?
It's your primary protection mechanism against future debt. Its main job is to shield you when life throws those inevitable curveballs, the car transmission dies, the furnace breaks, you have a big medical deductible, things that would normally send you reaching for a credit card.
Precisely. If you don't have cash reserves set aside specifically for these unexpected but statistically likely events, you're almost guaranteed to have to borrow again, probably at high interest. And that completely derails the debt elimination plan you've worked so hard on.
So the emergency fund isn't just peace of mind, it's momentum protection.
Exactly. It keeps you moving forward on your debt goals without getting knocked backward by surprises.
So how much should someone aim for? Especially someone in their 50s, maybe with more complex financial lives.
The standard recommendation is solid. Aim for 3 to 6 months worth of essential living expenses. Not your full income, but the bare minimum you need to cover housing, food, utilities, transportation, insurance premiums.
3 to 6 months. That can sound like a lot if you're just starting.
It can. So don't feel you have to get there overnight. Start with a smaller, achievable goal first. Maybe aim for $1,000 or 1 month's expenses. Get that first win. Then build on it systematically. Put it in a separate, safe, easily accessible savings account, not mixed with your checking, and definitely not invested in the market. This is your safety cash.
Okay, emergency fund is building. What's the next big thing to shield against? We know healthcare is a huge expense in retirement.
It's arguably the biggest unknown and potentially the single largest expense category for retirees. You absolutely have to plan for it proactively while you're still earning well in your 50s.
How much are we talking?
Well, estimates vary, but reputable sources suggest a single person retiring at 65 today might need somewhere in the ballpark of $170,000, maybe $175,000, just for their healthcare expenses throughout retirement. And that's after accounting for Medicare coverage.
Wow, that's a sobering number. So you need a dedicated savings bucket just for that.
You really do. Or at least factor it heavily into your overall retirement savings goal. And the single best tool for this, if you're eligible, is the Health Savings Account, or HSA.
The HSA. We hear about those a lot. Why are they so good?
Because they offer a unique and incredibly powerful triple tax advantage. You really can't beat it.
Okay, break down that triple advantage for us.
Right. 1. The money you contribute to an HSA is tax deductible in the year you contribute, so it lowers your current income tax bill, just like a traditional 401k or IRA contribution.
Okay, tax deduction going in, what's 2?
2. The money in your HSA grows tax-free over time. Any interest, dividends, or capital gains earned inside the account, completely tax-free growth.
Tax-free growth. And 3.
3. Withdrawals are also tax-free as long as you use the money for qualified medical expenses anytime now or in retirement. So tax-free in, tax-free growth, tax-free out for healthcare. It's amazing.
That is powerful. And who is eligible?
You generally need to be enrolled in a high-deductible health plan, HDHP, to contribute to an HSA.
And like the 401k, is there a catch-up for older folks?
Yes. Another benefit for our audience, if you're age 55 or older, you can contribute an extra $1,000 per year to your HSA, above the standard family or individual limit.
So it's another way to accelerate savings in those crucial years.
Absolutely. And here's a picker. After you turn 65, the HSA rules relax a bit. You can still take money out tax-free for medical expenses, of course. But if you need to take money out for non-medical reasons, you can do that too. You'll just pay regular income tax on the withdrawal, just like you would from a traditional 401k. There's no penalty anymore.
So it effectively becomes another retirement savings account after 65.
Exactly. It's an incredibly flexible tool for both healthcare and general retirement needs. Max it out if you can.
Okay, healthcare covered by HSA, potentially. What about long-term care? That's different from regular medical bills, right? Nursing homes and home care.
Very different, and potentially even more financially devastating. Long-term care planning is urgent to address in your 50s.
Why the urge?
2 reasons. First, the premiums for long-term care LTC insurance rise sharply as you get older. Buying a policy in your early 50s is significantly cheaper than waiting until your 60s. Second, your health is a factor. If you develop certain health conditions as you age, you might become ineligible for LTC insurance altogether.
So you need to lock it in while you're relatively young and healthy?
Ideally, yes, or at least start exploring the options and costs. LTC insurance is designed specifically to protect your hard-earned assets, your home, your savings, from being completely wiped out by the staggering costs of extended nursing home stays or round-the-clock in-home care, which can easily top $100,000 a year in many places. You need a plan. Either insurance or a very robust, dedicated saving strategy.
Okay, final piece of the shield. Protecting future income. Let's talk Social Security. How can planning in your 50s help maximize that?
Optimizing Social Security is one of the highest return, lowest risk things you can do for your retirement income. It's guaranteed inflation-adjusted income for life.
And the key is when you claim.
Absolutely. You can claim as early as 62, but your benefit will be permanently reduced. If you wait until your full retirement age, FRA, which is likely 67 for most people listening now, you get your full baseline benefit. But if you can delay claiming beyond your FRA up until age 70,
Your benefit increases.
significantly. For every year you delay past FRA, your benefit grows by about 8%. So delaying from 67 to 70 can boost your lifetime monthly payments by 24% to 32% compared to claiming at FRA. That's a huge guaranteed return.
But delaying means you need income from somewhere else between, say, 67 and 70.
Right, which is why planning in your 50s is key. Maybe you plan to work longer, or maybe you structure withdrawals from your retirement accounts to bridge that gap. Or this leads to the idea of a second act.
A second act.
Yeah, maybe not full retirement at 65 or 67. Perhaps shifting to part-time work you enjoy, consulting in your field, starting a small side business, something that keeps some income flowing in your late 60s.
What's the dual goal there?
Keep engaged and purposeful, which is great for well-being and financially. It allows you to delay tapping your own retirement accounts and delay claiming Social Security until age 70, maximizing that guaranteed income stream for the rest of your life. Every year you can afford to wait up to age 70 is usually money very well earned in the long run.
Okay, we've covered a lot of strategies. But what if someone listening is just overwhelmed? The debt feels too big, the plan seems too complicated, he just can't seem to get traction. When is it time to stop trying to DIY this and actually get professional help?
That's a really important question. If you're actively struggling, meaning you're having trouble making even the minimum payments, you're missing payments, maybe using one credit card to pay another, or if the sheer complexity of juggling debt payoff, savings, budgeting feels paralyzing, then yes, it's absolutely time to reach out. Don't wait until things get worse.
And who do you reach out to? What kind of professional?
You generally have 2 excellent options. First, you could consult with a fee-only financial advisor. They can look at your entire financial picture, debt, assets, income, goals, and help you model different scenarios and create a comprehensive plan. Fee-only is key, meaning they're paid directly by you, not by commissions on products they sell.
Okay, a financial advisor for the big picture. What's the second option? Maybe if the primary issue is just crippling debt.
Then the nonprofit credit counseling organizations we mentioned earlier are a fantastic resource. They specialize in debt crisis management. They can offer free or very low-cost help with budgeting, understanding your options, and potentially setting you up with a debt management plan, DMP, if that's appropriate.
So nonprofit credit counseling for direct debt help.
Exactly. They're focused specifically on helping people get out of debt safely and affordably.
And before someone pays any company for help, you mentioned there's one thing they can try themselves. For free, if they're already behind.
Yes. Don't just ignore the calls or statements if you're falling behind. Be proactive. Pick up the phone and call your creditors directly.
Really. Just call them.
Yes. Explain your situation honestly. Many creditors, especially credit card companies, would rather work with you to find a temporary solution than have the account go into default and get sent to collections. They might be willing to arrange a hardship plan with lower payments for a period or waive some fees. It costs nothing to ask, and it can buy you valuable time and prevent further damage to your credit.
Good advice. Okay, now let's talk about an option that often pops up when people search online for debt help, but one that our sources warn is extremely risky. Debt settlement companies.
Yes, tread very, very carefully here. Debt settlement is almost always offered by for-profit companies, and their model carries severe risks.
How does it supposedly work?
They typically tell you to stop making payments to your creditors. Instead, you save money in a separate account over several months or years. Once you've saved up a lump sum, the settlement company claims they will negotiate with your creditors to accept that lump sum, which is less than the full amount you owe as payment in full.
Sounds okay on the surface. Save money, pay less. What are the dangers?
Multiple dangers. Huge ones. First, when you start making payments as they instruct, your credit score gets absolutely hammered. Missed payments, defaults. It causes long-term damage.
Yeah, credit damage. What else?
Second, there's no guarantee the creditor will agree to settle. They might refuse the offer and decide to sue you instead for the full amount owed. If they win a judgment, they could potentially garnish your wages or put a lien on your property.
Wow, so it could lead to lawsuits.
Yes. Third, even if they do settle, the amount of debt that is forgiven, the difference between what you owed and what you paid, is generally considered taxable income by the IRS. So you could get hit with a surprise tax bill on that savings the following year, which you might not be able to pay.
Taxable income on forgiven debt. That's a nasty surprise.
And finally, these for-profit companies charge hefty fees, often a percentage, maybe 20–25% of the debt they settle, or the amount you save. So the actual savings might be much less than you think. The unanimous advice from consumer protection groups is never, ever pay fees to a debt relief company before they have actually settled a debt for you.
So debt settlement. Extremely high risk. Potential for making things worse.
Got it. What about another tempting idea we touched on, using retirement funds, like raiding your 401k or IRA to pay off debt?
This is almost universally cautioned against by financial experts. It might seem like an easy source of cash, especially if you have high-interest debt, but the long-term consequences are usually devastating.
Why is it so bad?
Two main reasons. First, you immediately lose all future potential growth on that money. You're stealing from your future self, and the power of compounding over years or decades is immense. You can't get that back.
A loss of future growth. What's the second reason?
Taxes and penalties. If you withdraw money from a traditional 401k or IRA before age 59 and a half, you will almost certainly owe ordinary income tax on the entire amount withdrawn, plus a 10% early withdrawal penalty on top of that. So a $20,000 withdrawal could easily shrink to $13,000 or $14,000 after taxes and penalties, maybe even less depending on your tax bracket.
So you lose a huge chunk right away. And the future growth. Exactly. The damage is so significant that many advisors actually consider tapping retirement funds for debt to be, in some ways, a worse last resort than even bankruptcy. Because at least with bankruptcy, your retirement accounts are often legally protected.
Which brings us to the final option, the one nobody wants to think about, but sometimes it's necessary: bankruptcy.
Bankruptcy is indeed a last resort because it has a significant negative impact on your credit report for a long time, 7 years for Chapter 13, up to 10 years for Chapter 7. However, for some people facing overwhelming debt with no realistic path to repay it, it can be the necessary tool to get a fresh start.
Are there different types?
Yes, primarily Chapter 7 and Chapter 13 for individuals. And the process isn't simple. It requires mandatory credit counseling before you file and debtor education after you file, both from government-approved agencies.
What's the main benefit?
The primary benefit is the legal discharge, the elimination of most unsecured debts. This typically includes credit card debt, medical bills, personal loans. It can provide immense relief.
You mentioned Chapter 7 and Chapter 13. What's the difference, especially for older individuals?
Chapter 7 is often called liquidation bankruptcy. It's generally for people with lower income and limited assets, beyond certain protected exemptions. Non-exempt assets might be sold to pay creditors, but most unsecured debts are wiped out relatively quickly. For seniors with little income, maybe living on Social Security and not much home equity, Chapter 7 can sometimes be a very effective choice.
Okay, that's Chapter 7. What about 13?
Chapter 13 is reorganization. It's for people who have a regular income source but need time to catch up on debts, maybe secured debts like a mortgage or car loan they want to keep. You propose a repayment plan to the court, usually lasting 3 to 5 years, where you pay back some or all of your debt based on what you can afford. For an older individual with, say, steady pension or consulting income and maybe significant home equity they want to protect, Chapter 13 might offer a path to manage the debt without liquidating assets.
And critically, what happens to retirement accounts in bankruptcy?
This is key. In most cases, qualified retirement accounts like 401k, IRAs, and pensions, as well as Social Security benefits, are legally protected assets in bankruptcy. They generally cannot be touched by creditors.
So, bankruptcy, while serious, often protects the retirement nest egg,
Yeah,
unlike raiding it yourself.
that's often the case, yes. It's a complex legal process, but sometimes it's the safer route for preserving long-term security compared to desperate measures like draining retirement funds or falling victim to risky settlement schemes. Hashtag outro. So when we boil it all down, this freedom plan we've been discussing, the philosophy is really straightforward, isn't it? The goal isn't just about scrimping and saving. It's about achieving that crucial peace of mind that comes from regaining control.
Taking back a wheel.
Exactly. And for men over 50 especially, this debt elimination strategy needs that disciplined dual focus we talked about. You've got to aggressively shed those high interest chains, the credit cards, the personal loans, while at the same time, you're leveraging every tool available, especially those powerful catch-up contributions to really secure your future retirement savings.
Because getting rid of debt creates the foundation, right? But real financial freedom, that ability to retire with gusto, that's built on accumulating wealth on top of that foundation.
Precisely.
Which leads me to a final thought for you, our listener, to maybe chew on after this deep dive. We highlighted that huge gap in net worth earlier. Remember, the median retirement savings for the 55-64 group was around $185,000, according to some sources. But the average was way up at $537,000.
Yeah, a massive difference.
What really stands out there is how much that average is skewed upwards by a relatively small percentage of people holding most of the wealth. Our whole discussion today focused on the personal finance strategies, the budgeting, the payoff methods, the saving needed to build that debt-free foundation to hopefully help you move from that median group towards the higher performing group.
Right, the individual actions.
But stepping back, what other systems, what broader things beyond these personal strategies? Maybe thinking about job opportunities or access to education later in life, maybe even Social Security reforms. What systemic changes do you think might be needed to help more men age 50 and overbridge that significant societal wealth gap so more people can truly retire with confidence and, well, with gusto?
That's a big question. Worth thinking about.
Definitely something to ponder. For now, keep learning, keep planning, and keep moving forward towards your own financial independence.
We'll catch you next time for the deep dive.